Index funds have typically outperformed comparable types of investments over the long term. Index funds also offer minimal costs, tax advantages due to lower taxable income, and low risk due to their high levels of diversification. However, you probably won't comprehend a word they say when you first hear about investing in index funds. They would sound as though they were using a different language. Index funds are frequently regarded as merely a fallback option. Even if your business fails, you could have already amassed $1 million. In today's video, we will be talking about investing in index funds for beginners and how to become a millionaire. But before anything else, it would be amazing if you subscribe and hit the notification bell so you'll be updated whenever we upload new videos. It's free and you can always change your mind later on. And that way, you can also easily be notified whenever we upload new ideas on how to earn more money. So, it's a win-win. With that said, let's continue. Part 1. Uncovering the lies. Let's get right to it. Your entire life, people have been feeding you lies about investment. For instance, when asked about investing in class, teachers would typically respond that it was only for wealthy individuals who could afford to employ specialists to handle it on their behalf. For a very long time, you believed that investing was not for amateurs or those with little money since you thought they wouldn't stand a chance. They also claim you would need to read all the financial newspapers and learn how to read charts. And they claim that it simply wasn't worth the time. Additionally, your family always seems so terrified whenever you bring up investing because they believe it to be the riskiest thing imaginable and unsuitable for regular people. These fallacies are precisely what the experts want you to think, since they are aware that investing in index funds is quite simple. It won't cost you much money to get started. There aren't many hazards, and generally speaking, you'll make more money over time. The unsettling reality is that an actively managed fund's average annual return is 2% less than the market as a whole. In other words, professionals typically perform worse than index funds. Furthermore, they always charge you fees, even if you lose money with them. Moving on to part 2, understanding the game. Once you grasp the language used in investing, everything becomes much simpler. And that's what we'll be discussing in this section. Take the S&P 500 for instance. They have a list of the top 500 publicly traded American companies. Amazon, Google, Apple, and more lately, Tesla are the major players. And a business runs the risk of being omitted from the list if it doesn't perform adequately. An index fund allows you to invest in every firm on the list with just one click, which is kind of the objective. If you invest in index funds, even if a few companies do poorly, the companies that are performing exceptionally well will more than make up for it. Over the past 10 years, the S&P 500 has generated returns that have been on average 13.6%. Those who have invested and kept an S&P 500 index fund for more than 20 years have never experienced a loss of capital. The terms Roth IRA in the United States, stocks and shares ISA in the United Kingdom, TFSA in Canada, and Super in Australia are commonly used. What does it all mean? Well, with these accounts, you can profit from your assets without paying taxes on those gains. But because they are so strong, they usually have boundaries. Use these accounts as your shield when investing. They are there for you. One method to accomplish this is by investing in index funds using the money in your protected account. And because the government won't take a cut, all the profit will be yours. Putting all of your money into one investment is undoubtedly riskier. There is no purpose in waiting if your investment, like an S&P 500 index fund, will appreciate over time. On average, your situation will worsen the longer you wait. If you don't have the money, just put in what you can each month. Sometimes you'll buy a stock when it's high, and other times you'll buy it when it's low. However, ultimately, this will be balanced, and this method is called dollar cost averaging. If you visit an investing website or app, you'll notice that there are these things called ETFs, which are sometimes confused with index funds because they are so similar. Both let you invest in a stock portfolio. The simplest approach to remembering the distinction is to just recall that ETF stands for Exchange Traded Fund. If we boil that down to its most basic form, it simply means that it is tradable throughout the day on the stock market. A price for an index fund, on the other hand, is only available for purchases and sales at the close of each trading day. But which is superior? ETFs generally have lower minimum investment levels, making them a better choice if you're starting out with little money. And a lot of brokers don't charge a commission for trading. This is not something that many people learn at such an early age, thus schools do not teach it. Open a custodial account in the US or a junior stocks and shares ISA in the UK to start investing while still under the age of 18. This Millionaire's formula's true secret ingredient is time, and you have so much of it while you're young. This is due to the interest beginning to compound and rise quickly as you continue to make contributions each year. It snowballs into something. When you reach a certain point, your interest earnings start to outpace your monthly investment by a significant amount. The earlier you begin, the better, because time will work in your favor. By the way, before we go any further, feel free to comment down if you have any questions or if you have any suggestions about particular topics you want us to talk about in the future. Done? Let's get going! Part 3. Mastering the strategy. Many people will tell you what to do without explaining exactly how to do it. Establishing your goals should be your first significant action. You merely need to figure out how much you would truly need to put aside each month if you wanted to become a millionaire. You'll have more than $1 million in your account if you can invest $250 per month for 42 years at an annual rate of 8%. If you can continue to invest that for another 10 years, you'll have more than $2 million in your account. Of course, if you wanted to invest even more, you could just accelerate the entire process. The next step is to choose the brokerage website you'll be using to open an account and make investments. The expense ratio, or how much they'll charge you annually, should be your primary concern. It goes without saying that you want to keep these as low as possible. The average returns are another factor to consider, but it's important to keep in mind that past results don't guarantee future results. Additionally, there are organized funds for other categories. Everything is thus simple to locate. Bonds fall under Category 1. When they require additional funding, businesses and governments will sell this form of contract. These guarantee a return on your investment in the future. These are frequently regarded as having relatively minimal risk, but also low returns. As a result, your portfolio should contain more bonds as you age. The second factor is balance funds. The idea behind these is that you choose the age at which you want to retire, and they will handle the rest of the work and discover the ideal index fund mix for you. This can be an excellent alternative if you wanted to invest without giving it much thought. These go up in 5-year intervals, and you can choose whichever matches your plans the most. The third factor is the company's location and size, being small, medium, or large cap. The final category, which is sector-based, is number 4. As a result, if investing in the energy, healthcare, or real estate sectors piques your interest, you can do so. The ETF also offers a wide range of sector investment alternatives. The available options have now been characterized. I'm hoping that everything becomes a little simpler. You may now invest in American businesses like Apple, Amazon, Tesla, and Google with ease. The largest firms in the UK, such as HSBC, BP, and Unilever, can be owned in small amounts. And your portfolio can also include bonds to provide some stability. That's how simple it is. We hope this video has enlightened you. So if you're interested in success in both your work and personal life, don't forget to click the subscribe button, because we will release more videos like this. Thank you for watching. Until the next time.